or is that what you're going to tell us?
Well, I guess it's just something that fascinates me, I guess. I don't know, I guess it's my personality to like try to know something really well.
Okay.
So, this is the kind of thing that, I don't know, it matters, it impacts,
That's true.
quality of life.
Right, right. It's important.
Yeah.
Right.
So, like, it's something that's interesting, so I
Uh-huh.
just kept learning about it, and over time, like, I think I found some things out that it seems a lot of people don't really know, so
Uh-huh.
I figured
Why not share?
share, exactly. Um, so then,
Sounds good.
also, it's also a little bit of a game.
Uh-huh.
Like
That's true.
I like, I engineered that, right? So I like to figure out ways to like
Uh-huh.
make things work.
Okay.
And so, that involves sometimes, like understanding the system.
Right.
So you can try to make the most of it.
Right, absolutely.
So, yeah. I don't know. Some, some of what I know, I think, is definitely very important for to be able to know.
Sounds good.
For business well.
Maybe it's too late for me to know. Either I
No,
know it or
no,
I
no.
don't know it.
Never too late. No, we're gonna do a little demo, which is kind of cool, and it shows that like, yeah, the earlier the better,
Right.
but it's never too late.
Right.
It's like, I mean, it's a basic concept of compound growth, which we all understand conceptually, but just to make sure intuitively we really get it, I think it's important. So I'm gonna do that demo just to make sure people see how compound growth really
Uh-huh.
makes a difference. Yeah. I was trying to think if there was any other forums, like any other people to send it to who might be interested, but I don't know. I just have to move on. I have a second session that I'm doing in a few weeks, so
Okay.
I'll just have to move on to that, and I guess we have this recording, so somebody missed it.
I mean, maybe people from all of EMC would be interested, not just RSA. I don't know who
Right.
you.
So I couldn't send it to her. Hey, this is it. It's empty. I don't know if more people are gonna come, but okay.
There's 3 of us. That's
Yeah,
something.
that's something. I'm recording it so that if anybody else, huh? כאן שפרתי. לא, הזמנתי דנו חסן, והוא אומר שהוא לא יגיע כי יש לו כבר one on one, אני באוטובוס איתו כל יום, אז מדברים על זה לפעמים. Okay, all right, so I'm gonna get started. So really, this is just the first session. I'm going to be doing, I'm going to do a few of them. The purpose of the group in general is to have a place to share financial ideas. People could teach their own topics, and also, to band together to do some collective bargaining. There's some things that I tried signing up for something called the Carnegie Stamut IRA. I couldn't really do it. They gave me this ridiculously high rate. If we had a bunch of people together, then that could have made a difference. It turns out I didn't do that in the end because they lowered the rate significantly anyway on the Carnegie Stamut and all that. So, I think the purpose of the group is just to get together a bunch of people who are interested in these kinds of topics so that we can bargain, learn about things, discuss things. In terms of ESPP, that's a topic that affects everyone in the company, and a lot of people they don't seem to know what they're doing. So I think I don't know. That's the purpose of the group in general, and I know we're starting with a few topics that I personally feel like they should be shared. Like a lot of people might not know them. So okay. Anyway, so first we're just going to cover the basics. We're just going to cover the basics initially. So start with compound growth. We all know what compound growth is. That's how money grows, right? In a bank account, in an investment account. The concept of compound growth is that it's an exponential curve, right? It's not a linear curve. If we make a certain percentage on our money, let's say we're making 4% on our money. If we make 4% on our money in a regular, non-compounded way, then we'll make the same amount of money today as we do tomorrow, as we do the next day. It's going to be the same amount of money that we're going to make. It's going to be a linear curve. Whereas exponential, the amount that I'm going to make tomorrow is more than I made yesterday. The reason is because there's more money. I made money yesterday. It compounded. So I made money yesterday. I made 4%. I made a certain percentage yesterday. And now, tomorrow, I'm getting that same percentage on more money. So compound is an exponential curve. It's how money grows in general, and it's ridiculously powerful. And we'll do a demo in a little bit that shows how powerful it is. But the takeaway is that the earlier you start growing your money, the earlier you're on that exponential curve. So earlier is better, and we're going to do here a little example. So we're going to take Sarah here.
Okay, I'm 22.
You're the smart one. Yeah, well, you did this already since you were 22. Yeah. I'm going to take Anton. And you didn't make all the best decisions, I'm sorry. So Sarah at age 22 started putting in 8,000 shekels per year into Keren Ishtalmut. It grew at 10% per year. There's no taxes on that. It just kept growing. And until age 42, and then you stopped. You didn't put any more money in. Whereas Anton put in 0 shekels starting from age 22. And at age 42, 20 years later, that's when you decided to start putting in 8,000 shekels per year. At age 67, at retirement, how much do they have? So this is to demonstrate the power of starting early. By the way, the power here is that, yeah, Sarah stopped putting money at 42, but it kept growing. She kept it in the Keren Ishtalmut. So it kept growing that percentage per year. And so that contributed to the final number. So Anton has 218,364 shekels. It's a lot for, you actually only put in, it was 25 years. So 25 times 8 is 200. So you made a little bit, but didn't have really much of a chance to grow. Whereas Sarah put in 160K, and she has 1,365,227 shekels by the time she retires. So starting early is better, just the concept of compound growth. So let's talk about maximizing returns, because that's really, at the end of the day, what we want to do. It's a very, very simple concept. If you get a higher percentage average annual return, you'll have more money in the end, right? The more, we talked about 10% growth here. If we could make that number as high as possible, 10% I think is a very good goal to reach for, then that'll obviously have a huge difference. So let's talk about the different options that we have. You can put your money under a mattress, right? And it has a risk profile. All of these have a risk profile and a growth profile. So everybody has a different risk tolerance, how much risk they want to take, and what they want to, how much they want the money to grow. So under a mattress, it's high risk, honestly. I mean, fire, theft, water damage. I read a news article where somebody kept their money under their mattress, and they found out, they looked at it like 20 years later for some stupid reason. They found that that's how they found out that they had a pest problem in their house. And it had eaten the vast majority of their money. Like it had disappeared from pests. So, and it also has no growth potential. So mattress is probably not the best place to put the money. It's not going to grow. In fact, it's going to lose to inflation, but let's ignore inflation here. In a bank account, negligible risk. There's really no risk. If the bank disappears, like in Greece, where you have bank problems, nothing is going to save your money. You're going to have inflation. You're going to have real issues. So, bank has negligible risk and negligible growth potential also. The bank gives almost nothing. They do these gimmicks like Banking Good. I'm in Banking Good. They give 3%, but it's up to your salary amount, and it's only for 3 years, and it's the maximum balance in your account for that month. So it's it's very limited. Real estate is relatively low risk, and there's moderate to high growth potential. And we'll talk about real estate, how it compares to other options. Not this time though. You can start a business. It's high risk. You have moderate to high, you have pretty high growth potential. You could do insanely well with a business. Also, what I need to mention is how much effort goes into each one of these, because it has an effort profile as well. You know, Under Mattress has 0 effort profile. In a bank account, it's also pretty much no effort profile. In real estate, it takes effort. You need to, you know, you have to go searching for it, and you need to deal with the bank, and it's a process. There's also a lot of fees. There's you know, that factors into the growth profile. So it costs money. You're going to pay, you know, lawyers' fees, and real estate fees, and broker fees. In a business, there's also high fees and costs. Then there's venture capital, very high risk, but it's insanely high growth potential. But that also takes a lot of effort. You have to investigate. Very often, venture capitalists, they are involved in growing the company. They you know, have a hand in it. They help manage the company. And then stock market will qualify this. To be qualified, it's low risk in the way that we're going to talk about it, and it also has a moderate to high growth potential. And it has like basically no fees, very minimal fees, and very minimal amount of effort that goes into it. So the stock market is going to be the focus of what we're going to talk about this time. In terms of that risk to growth profile, once again, everything has that. Anything you can do with your money has a risk profile and a growth profile. The question is, how do we maximize that and get the best ratio of those two? And experts really say that the stock market provides one of the best combinations of those. If you do it the way that we're going to talk about it, we're going to qualify what investing in the stock market means. So what is it? What is investing in the stock market? You're lending money. You're saying, I have some money, and I'm lending it. I'm lending it to companies that think that they could do something with it. You know, they want to grow, and so I'm lending it to them. They're going to be able to grow with this money, and so I am now taking a percentage of the profits by lending them money to grow. And your goal, when you're in the stock market, what your ultimate goal is to say, and it's not going to be this complex. We'll talk about that in a minute. But you're saying, to whom can I lend my money who will get the best return? And so that's what we're trying to figure out. It's actually very easy. It doesn't really take that kind of effort, but that's really what we're doing. We're lending our money to other people and taking a percentage of the profits. How much will it grow? That's a good question. We don't know. Nobody knows. There's no guarantees. But roughly speaking, the stock market represents how much anticipated value creation we see in the world, in the industry, in that company. It's anticipated growth potential. So if we think that EMC is going to do better within the next year, we might buy EMC because the stock market price generally reflects the growth potential that we anticipate. So it's a very subjective definition. That's a definition, but it's a very subjective way to apply it. There's really no objective price for a stock. But on the other hand, it's real because the stock price values the company. The value of the company, it's called the market capitalization, and that is the stock price times the number of shares that they have. So that it's a real thing. It's the actual value. It's the value of the company, but there's no. It's not like an objective figure. So we'll get to that. One way to help us understand how it will perform is looking at historical performance. How was it done in the past? And we have a lot of data for that, so that hopefully can make us feel a little confident with projections. All right, so you want some numbers. So let's talk about how much is actually done, how it's actually done. So I'm going to talk about the U.S. stock market because that's what I know best. It's grown on average since 1871. If we pick a way to measure the stock market, I'm going to pick something called the S&P 500, which we're going to talk about later. But if we estimate how much it's gone up, it has gone up historically 10.4% per year. That's not inflation adjusted. Obviously, after inflation it's lower. That's not tax adjusted. After taxes it's lower. But you know that's why we're going to take advantage of Kering Shamu, which does not involve taxes. So a really beautiful vehicle. Anyway, we're talking about average historical performance of 10.4% per year. That's a lot. That's really good. And you know, if we can tap into that, that'd be great. Over the short term, it's not necessarily so great, right? So people who have, let's say, 5 years to invest, the stock market is probably not for you because that would suck to lose 20% of your money in the next 5 years, which is reasonably possible, very reasonably possible. Over the last 143 years, the stock market has gone down 39 of those 143. So, so there's no guarantees. And 2 of those times were ridiculous, right? It went down 44% in the Great Depression and 37% during the Great Recession. That's your money that you worked for, ridiculously lowered in value. So the thing that I'll say in response to that is that historically the downturns have been inconsequential for people who are in it for the long term. Long term is, let's say, 10 years, preferably even more, 15 years. So yes, it's gone down, but overall it has not. And I'm going to show you a chart. Oops. I'm going to show you a chart about that. Oops. Okay. So this is the S&P 500. The S&P 500 is just what people often use to estimate stock market, what the stock market is in general. We'll talk about it a little bit more in a minute, but you can see how, well actually, so this is actually a pretty limited one. So let's choose, here, let's go to Google Finance Home. Because this only starts from 2011, so I'm going to go back to just the index itself. And this way you can see more data. Okay. See, it goes back to this index as it's tracked here goes back to 1975. It went down a lot in 2000 and then again in 2008. But overall, somebody who invested in 1975 when it was at $85, now it's at $2,000. So you could lose in the short term, but in the long term, historically speaking, it hasn't really lost value. It's not, in the long term, it's done quite well. So the takeaway here is you have to risk money to make money, and that's a given. We can't expect to make money without putting something in the stock market. We're only talking about long term, like I said. And here I'm gonna give you a little. This is kind of similar to what we did over here. If you invest 2,000 shekels per month in the stock market starting at age 22, and it performs about the same as it's performed on average historically, how much money will you have at age 40? So the answer is 1.2 million shekels. I think that combines. We talk about compound growth. So this combines that with the stock market, and you can see how it's it's a very, very powerful force. I want to show you a quick demo which shows just how powerful it is. So I could send you guys, if you want, I could send you this as a file. But basically, we could plug in a growth rate, any growth rate. Let's pick 9%, and your monthly contribution, starting age. And this is what I was saying before about how it doesn't matter when you start, but the earlier you start, the better. So if you see here, you see how we have, you have age in months just helps us to calculate the monthly growth rate, to apply the monthly growth rate. You see, here's the amount you actually deposited. It's 2,000 shekels per month. It doesn't change. After a year, it's been 12,000. I'm sorry. After a year, 2,000. So after it's been 24,000 shekels. But here, this is your savings. This is after you apply the growth rate, right? That annual growth rate of 9% is equivalent to a monthly growth rate of 0.72. They're the same thing. But what happens is you see it growing over here, and it grows to when you take it down. You start at 25. Let's look at age 30. When you hit 30, now you've only saved 2,000 shekels per month. You've only saved here 122,000 shekels, but for free you have an extra 30,000 shekels because of the growth. Let's take it to retirement age. If you save 2,000 shekels per month and you start at age 25, and you retire at age 67, the moment you turn 67, you will have saved 10 million shekels. 9 million of that approximately is stock market growth. So this is, I think, I'm in the stock market. I don't. We'll talk about real estate later. I don't own an apartment. Thank God I could buy an apartment. I don't want one. I want this. I want the growth rate of the stock market, it's tremendous. And this is, I think, a very important concept that I think a lot of Israelis, because of this heavy bias towards investing in real estate, which is good. I'm not saying it's worthless. It's a very powerful thing also. And maybe in a portfolio one should diversify and have also real estate, both real estate and stock market investments. But because the Israeli culture is so focused on real estate, I feel like a lot of people don't understand the incredible power of investing in the stock market. So I think this is a very important demo to see. You play with these numbers, I could send this out to you guys, but you know.
What about the 25% tax?
Right. So that eats away at this, and you'll have 25% less money in a regular investment account. Now here's the thing: you have Keren Ishtamut. Keren Ishtamut is not taxed.
Yeah.
And a lot of people who I've talked to, after the 6 years is up, they'll take out money from their Keren Ishtamut. I don't recommend it because it's growing like this over the long term. If you take it out because you want to redo your kitchen, okay, you wanted to redo your kitchen. That's good. That's important. You know, maybe you increase the value of your home, but be careful because you're missing out. That 25% tax is a big deal. And actually, the second session, which we're going to do on August 30th, is going to cover how to minimize taxes because it's a huge deal.
You can rebuild your own with this.
Yeah, exactly. You know, we'll do. You know,
in the kitchen.
In the third session, we're going to compare different options and how they pan out. With real estate, you know, a lot of people talk about how, you know, you're building equity. You know, you're putting money into the house, and at the end you get to sell it. Well, here you get to sell the stocks at the end, but also along the way. It's a very liquid asset. That's actually another thing that we didn't really talk about in the previous slide when we talked about the risk profile and the growth profile of putting money under a mattress or starting a business or real estate. The liquidity matters, right? In a house, if you buy an apartment, if you want to sell it, that's a balagan. That's a big deal, and it takes a lot of effort, and it's mostly an illiquid asset. It's very hard to get that money. Whereas here in the stock market, at any point, from a Keren Ishtamut, at any point, if you really do need the money, you can sell and you can take it out. So that's one benefit of all this. You know, so you know, you could imagine putting in another column to talk about value of home, and maybe the numbers will be relatively similar to this. They're not, historically, they have not been this high. You don't get a 9% annual return from a house. It's more like 6, 7, 8%. We're not talking about like Modi'in, right? If you know ahead of time what's going to be the hot real estate, go for it. You know, you have a crystal ball. If you have a crystal ball, invest in that. That's great. But the average residential real estate return is not like this. And you can imagine another column here of the real estate growth, which will also be very impressive. So the difference is, though, here, it's all liquid, and you can do whatever you want with it. You can buy a house eventually when you save enough money here. Anyway, so I think that's the takeaway of the power of the stock market. But remember, there's no guarantees. The stock market could go down to zero. It could, theoretically. I want to make sure that you understand some ways to reduce that risk. So we're going to talk about ways to reduce that risk. Also, I want to explain, investing in the stock market, investing in a stock, by lending the company money, you own a share of that company. So for a company to go down to zero, you own a portion of their assets. They have to have basically more liabilities than assets. They have to own more money than they have, and that's not even sufficient for the stock to go down to zero. Also, people have to lose confidence in their forward growth prospects. So stocks can go down to zero, it's true, but it's relatively rare. Although, you know, it has happened to me a few times. I was a penny stock day trader back when I was 15, and you know, it was a lot of fun. I learned a lot of lessons from that, but a lot of that went down to zero. I lost all my money that I put in there. So I'm not trying to whitewash it. Stocks can go down, but let's try to reduce our risk. So there's three concepts we're going to talk about for reducing stock market risk. One is diversification, and we talked about how a stock could go down to zero. The stock market, though, that's something else. So we'll talk about diversification more on the next slide. There's index tracking, which is a popular way to buy the stock market. And there's a strategy called buy and hold. That's what I recommend. Well, I don't recommend anything. That's what I do. That's what I would recommend if I was speaking to myself. Buy and hold counters a psychology of the stock market, which is actually pretty dangerous, which is the psychology in the human brain to buy high and sell low. We'll talk about all these topics in future slides. Diversification, we talked about how an individual stock can go down to zero. That can happen if they, like I said, if they owe more money than they have, than they're bringing in, than they anticipate bringing in. If you know, people who are investing in the stock lose confidence that the stock will generate a positive return, then they'll go down to zero. But the solution is to buy many stocks. Right? It's just a very simple concept. It doesn't apply exclusively to stocks, it applies in general. Don't put all your eggs in one basket, right? You want to be diversified with many things. It's a cornerstone of conservative investing. It reduces your statistical standard deviation. So yeah, a stock could go down to zero once again, but overall, many stocks are much, much less likely to do so. Even if one company fails, it'll hardly impact your portfolio. And we already said, you know, you own stock, you now own a share in many companies. I personally am not afraid that all these companies will go down to zero. So that's one way to reduce risk, to diversify. Let's talk about it some more. The different categories you can invest in. You can invest in companies of different sizes. That reduces risk, right? Sometimes with a low interest environment, right now we're in a low interest environment, it has a different profile for smaller companies versus bigger companies, right? It affects who can borrow money and how expensive it is. So it has a different effect on different companies. So if you diversify in company size, that will help to level out some of the changes that naturally happen. Companies' industry, right? Energy right now is a hot industry. Hot being like they talk about it, it's not very hot. It's really low and it's doing really badly. But a corollary of that is the airline industry is doing really well, right? So industry makes a difference, and in order to insulate yourself from the specifics of particular companies or particular industries or particular company sizes, we're trying to capture all of these. We're trying to buy into a lot of different categories in order to make sure that we're not overexposed to any one particular thing. We can diversify country where the company is located, right? That protects a little bit against currency fluctuations. And also other things, right? Companies in the same country tend to perform similarly to each other. So companies where, we talk about currency, bonds, cash, these are all things that we want to diversify into. Experts generally recommend using all of those categories. So you want to invest in really all of these things. It isn't perfect. You know, the Great Depression hit all these categories. All they went down, right? Nothing was protecting you. But you know, like we said, historically it's recovered and then some in every downturn. And like once again, like I said, we could always lose every breath. It's certainly possible.
Just a minute. Do you know how to read the annual report of a company or quarter? To what to expect?
I have done that. So I have done that, but that was back when I used to buy individual stocks. I don't do that anymore. I don't have any individual stocks, which we're going to talk about next. But it's a good thing to be familiar with that. I think that's a good point. You know, people should know how to read those reports, just to have a sense of you know, earnings and revenues, and understand how the different accounting affects historical future projections. And you're talking about projections primarily, yeah, right? So it's good to understand what companies' projections are. However, keep in mind that we're talking about the stock market. Market meaning a big place where people are constantly buying and selling, and because of that, the price at any given point reflects its true value. Now, once again, it's an objective number. It's not It's a subjective number. It's not objective. It's not. There's no formula to tell
Theoretic,
you.
yeah.
It's a very theoretical, fluffy number, right? But it is the right number because that's what the market decided it's worth, right? Whatever the price is what the market decides it's worth. What they project in their annual and quarterly statements and filings, it's already factored into the price. Whatever, if they say something awesome, it's already in the price. The people with algorithms to trade for them, they knew that 20 minutes before you even open the file, you know. So it's a good thing to be aware of, but there's a concept in investing called, and it's opposed to what I'm saying, but it's just to demonstrate a concept. The concept is buy on good news. Buy on bad news, sell on good news, right? And what's the concept behind that? The concept is it's already factored into the price, right? When bad news hits the stock, it's discounted. The price went down already, so that's a good time to buy. Obviously, if you're going to say, obviously we're not going to say buy just before bad news comes out. You know, if you have a crystal ball, then great. Then buy, you know, right before it's about to hit its peak. Sell right before it's about to hit its peak, and buy right before it's at a low. But in general, the concept is there's a concept for people who are picking individual stocks, which is not what we're going to talk about, to buy on bad news. And the reason is because once the news comes out, it's already factored into the price. So diversifying. So we now have to pick many stocks from many categories. This sounds really annoying. It sounds hard. That's not what we're going to do. We're not picking any stocks, right? We're also, by the way, not going to be asking pros to pick stocks. That's what we're going to talk about on August 30th. Hey, פעם שנייה?
לא, אני שמעתי, זה מעניין.
Okay. Good. So how are we going to invest in stocks without picking stocks? Okay. So I'm sorry that we covered only basics until now. Now we're getting to more practical things. Okay. Mutual funds, also known as ETFs, also known as ETNs, also known as two-day sal. There's differences between them, but it's the concept of buying one thing that has within it many things. Okay. We talked about the categories before. You know, by industry, by size of the company, by the country that the company is located in. All these categories, you can find a mutual fund for each one of those categories. Or you can find a mutual fund that tries to capture all those categories. That's what we're going to try to do. Specifically, we're going to try to capture something very specific called index investing. Index investing is a way of trying to capture the broader market. When I gave that number before of 10.4% annual average growth, I was talking about an index, which is called the S&P 500. It's an index. So now the question is, why do we have indexes? Why do we have, well, first let's talk about why we have mutual funds and ETFs. So it's because we talk about diversification. That's what we want to achieve. We want to buy diversified companies. You can buy all of the companies within an ETF. Well, let me explain what an ETF is. An ETF is a company, Migdal. Migdal says we want to provide, not just our clients, anybody. It's listed on the stock market, so anybody can buy it. We want to provide a way for people to buy the Tel Aviv 25. Tel Aviv 25 is an index. And so Migdal will say, this is our index. We're going to charge a fee for buying our index, but now you don't have to worry about buying all these individual companies. We've taken care of that for you. It is a big help, and they buy the right proportions, so you don't have the wrong proportions of the companies. You're buying a well-diversified mix in accordance with an index. Or you can buy an ETF that has nothing to do with an index. You can buy an ETF, like I said, for the energy industry, right? Right now it's been beaten heavily. Maybe you guys believe that the energy industry is going to do better. You can buy from Migdal, from IBI, from Mitav Dash. You could buy an ETF, which is just them buying all of the companies that they think are in the industry, the energy industry. And you buy that one ticker, that one thing in your portfolio, on your statement. You just show one thing, but you now have all of those companies. You've bought shares in all those companies indirectly. They charge a fee. I'm talking here about American fees. I don't know exactly how much they charge here. They charge, the lowest that I've seen here is 0.1% somebody tells me that they do it for free sometimes, but you're just gonna pay money on the bid-ask spread, whatever. The point is that there are relatively low fees in this range of 0.04%, which is basically nothing, right? I mean, that's awesome. If you can pay 0.04% fees, you're basically not paying fees. All the way up to 1.6% fees. That hurts, right? 1.6%. If we go to our demo and I change that 9% and subtract from that 1.6%, it hurts, right? It's gonna be a lower number in the end. So that's gonna be next time. We're gonna talk about lowering fees, but bear in mind that they're going to charge a fee for this service. They're built with diversification in mind. That's what they're trying to do. Hundreds of choices. We said already before that we're going to focus. Yeah.
Fees per deposit or per year or something?
So good question. So now, the fees that you're going to pay in your account are three, right? You're going to pay taxes to the government.
Okay.
You're going to pay fees to the brokerage company, okay? That's the company that you have an account with, okay? So you have an account with IBI. You're going to pay fees to them. Commissions, every time you buy and sell, they might have a monthly fee also. Most of them have a monthly fee, some don't. You're gonna pay them that fee. You're also gonna pay this fee that we talked about, that 0.04% to 1.6%, that's not to your brokerage company, that's to the company of the security that you bought, of the ETF, of the mutual fund, the 2.sal that you bought. So you're in Meitab Dash, you're in IBI, I said, and you buy the Tel Aviv 25 index through Meitab Dash.
So there is a double fee.
Yeah.
You can also another call.
The commission should be extremely low. If you're paying something higher than a negligible amount for commission, you're doing it wrong. You know, you should be paying very, very little for commission. If I remember correctly, I think it's like 0.09% in commission, if I remember correctly. For IBI, I was looking into it for IBI. I keep my money in America. And the reason is because their commissions are a flat fee, not a percentage. It's per trade, and so it ends up being for, at some, it depends on how much money there is, but at some point it becomes cheaper just to, pay $5 for a flat fee instead of 0.09%. But yeah, so it is two fees. But you can keep both of them extremely low, right? If it's 0.09% plus 0.04%, that's 0.13%. That's not so bad. Not so bad. The taxes are much, much worse.
Okay.
So in index investing, you're trying to get all of those categories, like I said before, and the fees on the index investments typically are at that lower end of the spectrum, closer to the 0.04%. Why? Because there's nothing for them to pick. Right? The index is already some other company which doesn't charge fees in this way. We won't pay them any fees. Some other company decided we're going to make an index. We're going to decide the Tel Aviv 25. We're going to pick which stocks go in the Tel Aviv 25. It's already picked. They don't have any work to do. I mean, it's really like highway robbery in a way. Even the 0.04%, right? Because what are they doing? There's administrivia, there's filings, whatever. It does cost them something. Anyway, and they deserve to make some money too. But there's less picking, so the fees are going to be lower. Examples, you recognize these: Dow Jones Industrial Average, S&P 500, NASDAQ 100, Tel Aviv 100. These are indexes. There's one slide that you remember. Think of this. Warren Buffett? Warren Buffett said, "My advice to the trustee couldn't be more simple." This is famously the best investor of our time, of all time perhaps. Most respected investor. Put 10% of the cash in short-term government bonds. This is for diversification purposes. You don't want to put all your money in the stock market. And 90% in a low-cost S&P 500 index fund. I suggest Vanguard's. I follow his advice. VOO, right, exactly. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. Warren Buffett, who manages a company that invests money for other people, tells people not to invest money through that kind of a company. Now, obviously he's going to tell people to invest in his company specifically, but in general, his generic advice to this is to his trustee of his estate. This is his money. He suggests investing in 90% of the money in an S&P 500 low-cost fund. Right? That's what I take to heart to understand the power of this kind of investing, and that's the demo that we showed before. That's showing actually how this perspective has done historically. One thing I want to point out, which we're going to cover on August 30th, is he points out whether pension funds, institutions, or individuals who employ high-fee managers, right? So we said how in an index fund, you're going to pay a very low fee of 0.4%. But any ETF, even the ones that pay 1.6%, all of those are called passive investing, right? You're just buying an ETF and you're holding on to it, right? In general, these are fluid definitions, but in general, you're buying an ETF and you're holding it. You're not picking a stock and then selling and then buying this stock and selling it. Those typically, 0.04% to 1.6%. If you do what pension funds do, like Carnegie Stramut, what they do is they have stock pickers. Stock pickers, once again, we're going to cover this next time. Stock pickers, not only don't they do as well as index funds, but they charge ridiculous fees. This 1.6% typical maximum, it's not a maximum, but it's the high end of what you might pay on an ETF. They're going to charge more than that, regardless of whether they beat the market or not. And they're probably not going to beat the market. When I say the market, I'm typically referring to the S&P 500, but you could use whatever measure you want. So, it's a dig against those institutions, including our Carnegie Stramut, which is why I mentioned before I was looking into a thing called Carnegie Stramut IRA, where we're not bound by these Maslulin where they actively pick stocks, but it's for another time. So let's finish this topic of diversification. So if we want to diversify properly, what I personally think is properly, we might buy an index ETF or two to capture the broader market. We also might want to pick up some other ETFs in other categories. We might want to focus on emerging markets. And I'll show you, on the last slide, I'll show you a sample portfolio, what a portfolio might look like of somebody who follows my blog and asks me to review their portfolio. I asked his permission, and I pasted on the last slide a portfolio of somebody who thinks like this. You also want to be in some super safe assets, like cash, bonds, because, like Warren Buffett said, 10%, the stock market can go down and you want to be somewhat insulated from that. If you want to retire, let's say 5 years from now, you're going to diversify much, much more towards cash and bonds than the general stock market. So this is dependent very much on when you need your money. I said at the beginning, this is for long term. As your horizon becomes less and less long term, you're diversifying more and more towards the super safe assets and the safer assets than the stock market. Many online calculators could recommend a statistically sound percentage mix of all the categories. In terms of a very simple rule of thumb that a lot of experts recommend, it's called the rule of 100. The rule of 120 is a more common thing that they say now. Basically, take 100 or 120, subtract from that your age, and that's the percentage you should be in the stock market. So if you're 35 years old, then you should be 65% or 85, depending on how much you believe in the stock. I'm a 120 guy. You couldn't tell I believe in the stock market. But you should be diversifying as you get older. You want to be less and less in the stock market. Like I said before, from now on, when we talk about investing in the stock market, we're talking about index investing, well-diversified index investing. Last slide, just to show you a practical summary. This is somebody who showed me their portfolio. VU, so you recognize VU. VU is S&P 500 Vanguard. It's basically what Warren Buffett recommended. This is the ETF version. There's a mutual fund version. This is what Warren Buffett recommended.
And also dividends.
Right, that's an important point, actually. Thank you for reminding me. The return is not just that chart that we looked at. Remember, we showed that chart on Google Finance. That's not your returns. That's not the full picture. The full picture is that plus dividends. Companies often pay dividends, including EMC. And if you invest, especially in these larger companies, which most S&P 500 is mostly larger companies, they often, not all companies, but a decent percentage of companies pay dividends. That means that they give a certain percentage based on how much stock you own, and just money. Just deposit money into your account. You can reinvest those dividends, you can take it out as cash. The point is that that's part of the growth. It's a very good point. So here, 40% of this guy's money, he's young, so he's very heavily exposed to the stock market, but 40% of his money is in large cap index fund, 2 funds. By the way, the fee for VU is 0.04%, or 0.05%, I'm sorry. It's basically as low as it can get. QQQ, I personally have much more than 4%. It's technology focused. QQQ is focused on the NASDAQ, and the NASDAQ is a very tech heavy index. I personally, remember I said before what the stock market is, it's conceptually, it's your belief in the value creation of, forward-looking value creation of what you're buying. I believe in the forward-looking value creation of tech. That's what I believe in, right? If you, value creation, by the way, I'm sorry if I didn't explain this well before, but value creation is an important concept. The world is not financially a zero-sum situation. It's not zero-sum. It's not like there's such a thing called value creation. For example, the agricultural revolution. After the agricultural revolution, when we were able to farm better and produce higher yields, we did much higher yields compared to previously, that was value creation. There was more in the world that people were willing to pay for. So Facebook created value. It made something that previously didn't exist that people are willing to pay for, and heavily. It created a ton of value. The world in general creates value over time. So I believe in technology stocks. So I'm actually, I have a roughly equal mix between VU and QQQ. But those two are tracking large indexes. American indexes, the Israeli indexes are also very, very solid. You have to be a little careful about currency risk, things like that, but don't be scared about any mitigations. After the last lecture, somebody sent me a very interesting article about how there are people who as soon, right before a company is announced to be included in an index, right? This S&P 500, somebody decides which companies are in the index and which ones are not. And once in a while it changes, not often, but it changes, you know, it's 500 companies. So, you know, let's say they think a company doesn't represent what they're trying to encapsulate, so they might get taken out and another company will be brought in to replace them. So he sent me an article about how when a company announces that they're going to be included in an index, all these investors with algorithms, they like immediately buy and they drive up the price because this institution, you know, all these institutions who let's say Mitab Dash has an S&P 500 index fund that you're actually able to buy. They're not allowed to buy that fund. They have rules about when they can buy. You know, they have a certain waiting period before they can buy. They're larger institutions. They can't buy it as nimbly, as quickly, as flexibly as these individual investors with algorithms or hedge funds with algorithms. So it drives up the cost, and so there's a ton of money that we collectively lose when we buy index funds to these people who buy on automated things, right? So he was all scared about that. I said, yeah, it's true. It costs us money, but you know, don't throw out the baby with the bathwater. You know, think about it. You know, yeah, okay. So let's say you lose 0.2% to that. All right. You know, so instead of 10.4%, you get 10.2%. Yeah, this is after that loss. So you get 10.4% instead of 10.6%. Okay. You know, my point is that there are things to think about. I mentioned currency risk. There are things to think about, but it's better if this is something that you believe in and you think would be a smart thing to do, it's better to get started with it instead of having to worry about all these other things. The sooner you start, if you agree with me that this is a promising option, it's better to start than to not start, you know. Including taxes. If you have a smart way of doing it with taxes and a not smart way of doing taxes, or you could do nothing, better to do the not smart way, you know, and, whatever, we'll address the taxes anyway, but better to just get started, in my opinion. They have online diversification calculators. I sent out a document with this invite. If you double click on it, you'll see there's a file. I have links to all these things. I have links to an online calculator if that's interesting to you. You can do your own research by Googling low-cost diversification and then put in the diversification category, and then ETN or 2.sal or whatever. You buy American securities too. You can buy an ETF or a mutual fund. The Israeli brokerages will let you do that. And just to review his portfolio a little bit more, you have mid-cap stocks, you have small-cap stocks. Cap means capitalization, so these are companies worth a middle amount of money. That might be a company that you vaguely recognize, but it's not like a Fortune 500 company. It's not like a major company. You have small cap, which is maybe a company, maybe a company you'll see down the road. It exists. It's not an international company. It's maybe they have like 3 branches or something like that, and they're publicly traded on the stock market. You have international. You have emerging. Well, for him, he's American. He's making Aliyah next month, but Tel Aviv 100 is international to him. Here, international would be America. And the reason why it's international is because here your salary is in shekels and you're subject to the Israeli economy in a lot of different ways. And by buying in another country like Europe or America or South America, you're diversifying better. So international, it doesn't matter how you define it. If you're, as Israelis, we need to buy not Israeli stuff too, to be diversified properly there. Emerging markets, that's like India, countries that are not really doing so hot. Historically, they're like third world countries, but have a lot of potential. They're typically less stable. You have real estate. So by the way, we'll talk about this more another time, but buying an apartment is really there. You could buy an apartment via a real estate ETF. It's the same thing, but it's liquid, and you're not committed to buying 1 million shekels worth in one go. So you can capture that exact same return with. So this is somebody who does believe in the real estate market a little bit more than I do. So you can capture that. They're typically called a REIT, R-E-I-T, Real Estate Investment Trust. Commodities index, bonds. Bonds are super safe. It's like cash. So this guy only put 3% in. It's probably smarter to put in a little bit more at most stages. And the last thing I want to just mention is there's something that you can do instead of buying all that. You can buy one stock. It's called a target fund. A target fund, they set a date. So it might be called. I had a target fund for a little bit. It's called Fidelity Target 2045. 2045 is the year in which I intended to retire. So what they do, Laviut, is they diversify inside of that one stock. They diversify in all these categories, and Laviut, and over time, of course, they move more and more towards the safer securities like bonds and cash and treasury bills and things like that. So over time, they'll move more and more, and when you get closer to 2045. That's one option. It sounds easier. They do charge higher fees. And as I'm going to talk about Laviut, and I'm going to talk about next time, lower fees makes a big difference, and there are ways to minimize them, and that's one of them. By buying 10 things, or even less, you get away with buying 5 things, and most experts would probably still call it a very well-diversified portfolio. Instead of buying a target fund, you'll pay lower fees. So that's it. Questions? Any?
Two issues. One IPO. An IPO, like Facebook or Twitter or something like that. With advice. IPO is when the company announced Nasdaq or going to trade.
Right. They're going public, right? So previously the company was private and it's owned by individuals, and without the say-so of somebody in the company, nobody else can buy shares. By going public, it means anybody can buy shares, and with it often comes voting rights, and having an impact on the company's direction, what the company does, etc. So an IPO is when a company first goes public, when you can first buy that company. They're associated very often with a jump right after in the 2000s. I mean, it got ridiculous sometimes. You could go up 100% in a day, in the first minute, after it comes out. They're often associated with hype. the reason why they're so volatile, or there's so much risk associated with them, is because, like we said, a market price is a market price. It's what the market deems is worth. And before it's on the market, you don't really know how much the market thinks it's worth. They try to estimate it. They, that's their goal. They want to approximate as much as possible. They don't want it to jump an absurd amount. I mean, it does create good buzz for the company, but a lot of people miss out on making money if they do that. They definitely don't want to overestimate the value of the company. That hurts the company's buzz very heavily if they go down the first day, which happens. Facebook, if I remember correctly, Facebook did go down on the day of its IPO.
The first day, but since then,
Right.
only up.
I do not. I typically would not recommend an IPO. I would not. I don't recommend anything. Let me be clear about that. I'm not recommending anything. I do things myself. I'm just sharing my perspective. I would not buy an IPO because that's picking individual stocks.
Yeah.
Right?
Yeah.
And it's a little nerve-wracking to not know what the market price is. Also, in order to be eligible to go in an IPO, very often you need to tie up a lot of money. You need to put in, typically for people who have, the truth is that I've never done it in this manner. I've only been on an IPO if I happen to have a connection to the company prior. Do you have this room now?
לא, אני רק רציתי להראות למדריכים של הקייטנת המקום, תמשיך.
Okay.
סליחה.
I typically have not been doing IPOs, and my experience was not like that, where you basically there's a company that will go around and, like Goldman Sachs, that's their job, to raise money for an IPO, and they'll go around and try to sell the IPO around. Typically, the people who can go in on the hot IPOs are people with a ton of money. So you have to tie up a ton of money. It's risky, It's not my style, so I don't know. I wouldn't do that. It's very boring what I do. Very boring. You just buy a few things and you hold it for long term. It's not exciting. The exciting part is hopefully when you turn 67. That's exciting. You say, how much do I have? But by the way, one thing I didn't mention is that with this approach of index investing, there's less headache. There's less stress. You're not thinking as much about, what should I buy? Stock picks. You don't have to think about that. And it might be a little ironic. Some people, it might sound like the opposite of what they'd expect. The experts who try to pick stocks, they typically do worse. So the thing that scares people about the markets, picking stocks, is really a bad thing, and it would do better to not pick stocks. It'd be better just to. Anyway, so next time we're going to talk about reducing fees. So that's taxes and investment pros. Spoiler alert: don't use investment pros. Don't use an active money manager. We're going to be talking about. I don't remember. I wrote it up in the email. We have a few topics, but basically minimizing the costs. We talked about maximizing returns already, and some practical advice also, some practical perspectives for somebody who wants to just get started. They're not sure where to start, so that's also something. And a few other topics in mind, but check out the calendar invite for this one. I wrote the future topics. Any other questions? Anything else wasn't clear that you guys want to talk about? Maybe I have.
If you want to start investing, you already have some amount of money. I heard two approach how to start, or to put every month, or I don't know, every quarter, a little bit fixed money every time, or if you have, let's say, I don't know,
A lot of money at once.
Put it right now.
You're talking about dollar cost averaging compared to buy and hold, and that we're going to cover that next time. So the short answer is buy and hold. That's what I found is the smartest way of doing it. Dollar cost averaging, buying in increments, is not that much worse than buying and hold, than just buying all at once. But what's the thought process? The thought process is, it's very simple. If you believe that there's a statistical likelihood of the markets going up over time, right? Time is generic, Not, you don't know about tomorrow, you don't know about the next month, you don't know about the next year, you don't necessarily even know about the next 10 years, but over time you anticipate that the stock market's going to go up. Your statistical likelihood of making your expected value, your statistical expected value will be higher by being in the market for as much time as possible, right? So buying the whole, just lump sum, everything at once. If you have a certain amount of money available to invest, buy it right away is what I do. But we'll talk about it next time. There's a very, very interesting study that people did on that, and I'll walk through it next time. Maybe I can do a little demo on that next time. So I'm going to talk about that. And one thing that I forgot to say, actually it's related to this, for what we're going to do next time is, one topic we're going to cover is, don't try to time the market. Timing the market is, in a way, it's that. In a way, you know, by saying 2,000 shekels now, 2,000 shekels next month, I don't want to invest all my money that I have available to invest at once. You're trying to time the market. You're saying, I think I know how the market's going to do, instead of just a broad perspective, which I have of the market over time just going up. So don't try to time the market. Don't try to read charts. It's a very strong perspective of mine. We're going to talk about that next time also. I can't tell you how many, the more of a beginner stock investors are. You know, people, I spoke to somebody here who I mean, you know, there's no such thing as a stupid question, but like, it was like stupid, you know, he was like looking at this chart, and he was saying like, okay, now it's bound to go up. It's an easy thing to fall, an easy trap to fall into, and that's what we're hardwired to do. Our brains are hardwired, like I said, to buy high and sell low. We're also hardwired to think that we can read charts. We want to see patterns, right? You know, psychologically we're programmed to see faces in things, right? Our brains like to discern patterns in things. And so when you see a chart, very, very tempting to try to predict the future based on what the chart shows. I wouldn't do that. So we'll talk about that more significantly next time. That'll be in 3 weeks. On August 30th, we have the second session. Anything else? I'm here. I have time. I know it's 11:02, but there's happy to talk about this. I'm also happy to talk about this stuff in private. So if anybody wants to come over to me and chat more.
Thank you very much.
Sure. Thank you.
When is the next meeting?
August 30th. I'll send it out. I'm going to send it out hopefully today.